Welcome back. As promised from the sidelines of the Motilal Oswal 20th Annual Global Investor Conference, we now have with us Gautam Duggad, Head of Research Institutional Equities, Ajay Menon, MD and CEO Broking and Distribution, and Ashish Shanker, MD and CEO Motilal Oswal Private Wealth. Gentlemen, thank you very much for joining in. You all have been in discussion with more than 200 corporates. There have been more than 15,000 one-on-one meetings spread over the last 2 days and today, of course. And the attendance has been with marquee corporates, HDFC Bank, Hero, Godrej Consumer, Mankind, Trent. The list is endless. So, Gautam, let me start this discussion with you. Conventional wisdom tells us that market returns track earnings growth. Now, Q1 has been muted, and I think in your note you highlighted the biggest disappointment was the beat to miss ratio. The earnings upgrades to downgrade ratio was just 0.4x, which is the worst that we've seen in close to about 3 years. Is that concerning to you? And what was the feedback from the corporates with respect to earnings growth for the remainder of the year?
Hi, Rima. Good morning. Thanks for having us. So, yes, the earnings season began on a slightly muted note, or rather the year began on a muted note, but it was still in line with expectations. We were expecting that. Yes, of course, the breadth could have been slightly better, and maybe the small cap earnings were slightly more disappointing. But as far as the full year is concerned, we are still quite confident that we should clock 10 to 12% earnings growth this year, which, depending on where you come from, looks either very moderate or reasonably okay, given that this 12% will come on a base of 30% earnings growth of last year and on a base of 4-year CAGR of 20% earnings growth between FY20 to FY24. I mean, the scale of earnings have gone up significantly, Rima. 4 years back, the Nifty total profits were 3.5 lakh crore. Our coverage universe, 300 companies' profit was 4.3 lakh crore. Today, that number is 11 lakh crore for our coverage universe and roughly 8 lakh crore for Nifty. So yes, this quarter began on a slightly muted note, but from here we expect things to pick up. The next 3 quarters we are expecting growth at about 5, 15 and 18%. That is how the entire year's growth aggregates to about 11%. Coming to the second part of your question, as to what the corporates have been saying, yesterday we had 8 CEO tracks, and since morning today we are already into the second CEO track. The outlook remains quite strong. We've had corporates representing financials, consumption, manufacturing, and even commodity in the CEO tracks which have already happened so far. So growth outlooks look quite decent at the macro front. The heartening thing is that the rural seems to be picking up. That is the common feedback that we are hearing from multiple corporates, those who presented in the CEO tracks, as well as the ones who are attending the corporate meetings. So rural seems to be picking up after a long time, almost 3 years. So that is a very positive sign. The private capex also is taking a baby step now. Government has done its heavy lifting, and it looks like in the next 12 to 18 months, you will see private capex taking bigger shape now. So those are 2 very important takeaways coming in from our CEO tracks and corporate conversations so far in the day 1 and day 2.
Gautam, very helpful there. So the pickup in rural and private capex, right? Before I head to our other 2 speakers on the panel, I just wanted to complete this discussion with you, Gautam. This is Sonia here. One growing trend that we're seeing in India right now, which continues, is urbanization, right? I mean, as of last year, 1/3 of India's population now lives in cities. And because of that, we are seeing themes like real estate, whether it's, home building. Today, this whole cables and wires theme is doing very well. In your discussion with corporates, is this a big theme that people are speaking about? And if yes, how does one play this theme now?
Absolutely, Sonia. This has been a big theme unfolding since last 3 years. And the best way to play this theme is direct, rather than taking first or second order route. So the direct theme is real estate. We are having Godrej Property CEO session today, later in the afternoon. We've had a huge overweight on real estate for last 3 years now. If you look at the numbers are staggering. The pre-sales have gone up 4x in the last 3 years. The cumulative pre-sales CAGR of the coverage universe of real estate stock that we track has been upwards of 30%. And even on that high base, the next 2-3 years, we're expecting 25 to 30% CAGR. So if you have a slightly higher risk appetite, the direct way to play this theme is to take exposure to real estate stock. They've had a phenomenal run-up in the last 2 years, so maybe there could be some cool-off here or there. But the trajectory looks very solid to me. We are still in the early part of the middle of the cycle. This cycle, I think, can last another 3-4 years. The absorption rates in the top cities, 7 cities, are going up. And then, moving forward, you can take exposure to consumer durables, cables and wires, as you mentioned, where we have, KEI in our model portfolio. And then there are a host of other names which are adjacent to that theme, something like ceramics, the broad consumer discretionary pocket. But the best way to play such theme is to take a direct exposure, which is where we have a big overweight on real estate stocks.
Ajay, when at the beginning of the conference, we were chatting with Ramdev Agarwal ji, and he said he wants to gauge the FI view, the stance in India post the elections, or are high valuations still going to keep them away? What was your feedback when you chatted with the foreign institutional investors?
So I think, as we all know, that the overall market in this last 2-3 years has been led by the retail boom and the flow of money which is there. And that is what has been the very strong markets which we have seen due to the flows coming from the overall retail participation. But I think when we talk to the FIs and all, they are just waiting for opportunities to come in. That's what we can understand. And I think overall the India story is just here to be. We have got a stable government in place. We are also looking at the macros which are very much well in place for India. So looking at the overall global scenario, what we are facing today, and compare that to India, when we talk to the FIs, there is surely a lot of positive momentum to come to India. Now, question is the valuations. Surely India is a little more at a premium currently. But I think at the right opportunity, there is more money to come in. And along with that, the retail flow is continuing. So the story continues. That's what we feel. But surely short corrections are good to start investing again.
Okay. Ashish Shanker, coming to you, of course, the next big event that everyone's going to watch out for is the September Fed meeting. And the expectation is that it'll be the start of the rate cutting cycle. If and when that happens, what does this really mean for a market like India? Do you think that good news has been priced in? The fact that more money flow comes into a market like India, how does one read into it? And what's the assessment from, a lot of the investors or stakeholders that you have spoken to at your conference?
Yeah, hi Sonia, hi Rima. Really exciting to be speaking to you on the sidelines of our Global Investor Conference. So I think, see, the big shift in this bull market is the color of money, right? If I look at the past cycles, we would always try and think as to what the FIs will do, because they were a formidable force in markets. But no longer. I think the big shift is the emergence of HNIs, ultra HNIs and family offices. In fact, even in the conference that we are attending, we are seeing a huge number of family office investors, ultra HNIs attending this conference and talking to companies. So what is happening is that every time FIs are selling, the retail investors, Ajay just spoke about, they are becoming a formidable force, because you see the number of demat accounts, the pace is not abating. You're still adding 42 lakh demat accounts every month. Similarly, if you look at the emergence of HNIs and ultra HNIs, there are about 40,000 ultra HNIs households in the country. There are about 2 lakh HNIs, and if you go further down the curve, the number just goes up 10x. So whilst there are these events on the anvil, Fed is definitely a big event, and I think the Fed has become much softer from 6 months back. So there is a clear expectation that before the elections are announced, there should be a policy rate cut. However, I can tell you that at every dip, there is enough liquidity on the sidelines which is waiting to come in from HNIs and ultra HNIs. We saw it just yesterday, where FIs were net sellers, and it was a typical day in Indian markets where FIs were net sellers, but you saw that HNIs and ultra HNIs as well as retail were net buyers. I don't see this trend abating. So whilst rate cuts etc. will definitely give a slight booster to the sentiment, but having said that, I feel that there is enough liquidity on the sidelines to come in at any dip that happens in the near future.
Gentlemen, do stay on. Ajay, Gautam and Ashish, we want to slip into a very short break, but we've got more questions for you, so we'd like to continue the discussion on the other side.
Welcome back. We are in conversation with the management at Motilal Oswal. It's a part of the Motilal Oswal 20th Annual Global Investor Conference, and we're getting many insights into what investors, stakeholders, corporates are thinking about. Gautam Duggad, Ajay, Menon and Ashish Shanker are still with us. Gentlemen, thank you for, taking the time out, precious time from your conference. Gautam, you spoke about many themes, right? Whether it's the pickup in rural, whether it's real estate, whether it's urbanization, private capex. Anything else that stands out for you, which could be a big theme of the rest of 2024?
So, Sonia, I think within the broader umbrella of financialization of savings, we are particularly very excited about the whole capital market architecture, which encompasses so many different subsectors. Your broking, wealth management, AMCs, the capital market infra firms, because as Ashish was mentioning a couple of minutes back, the demat accounts have gone up from 3.5 crore in March 20 to almost touching 17 crores now. And we feel that even if the momentum were to subside a little bit, we're still on our journey to track at least 25-30 crores demat account in the next 2-3 years. You must have read that in the month of July alone, 54 lakh folios were created in the mutual fund industry. SIP amount everyone is familiar with, whether on a gross or a net basis. So clearly this is a theme which can multiply manyfold. Already it is doing very well in the last 12-18 months, but I think we are still scratching the surface over here. And the second theme which I just want to mention is on the consumer discretionary side. 10 years back, consumption was very limited to FMCG and retail. Today, when you look at the consumption canvas, it is expanded significantly. You have hotels, apparel, jewelry, QSR, footwear, and I think many more interesting companies will be listed here. Today, we began our track with a very interesting and insightful presentation by the Zepto founder. So I think as, the days pass, the opportunity to benefit from this increase in disposable consumption in India, it's going to present several opportunities, and the traditional way of playing that theme has changed significantly. Who would have thought 2 years back that Trend can become a 2 lakh crore market cap company? Or for that matter, companies like Zomato, Varun Beverages. So we remain quite excited at Motilal Oswal about the evergreen consumption theme, and within that, the consumer discretionary part. So these are two things I just wanted to highlight.
Any red flags from your corporate conversation?
So far, none, Sonia, but the red flags are always the ones which you are not aware about. Because the market always corrects more on events which you cannot forecast. You go back to 2007, 2013, 2017, 18 ILFS, and then COVID. So I think a big durable correction, which has not actually happened in the last 15 years in this market post the, the global financial crisis. But any correction which is an order of magnitude more than 10%, as typically happen in India on events which are not forecastable. The usual red flags are always around, the corporate earnings slow down, crude prices shooting up, in a world which we are living in where every week there is some geopolitical crisis, but market discounts those crises very fast because they are known things. The market typically corrects more on things which are unknown and which cannot be forecasted. So that's what I think will be the biggest red flag. Something which we don't know, because market valuations are very rich now. Nifty reasonable at 20-21 times, but mid caps and small cap absolutely expensive, trading at 60-70% premium. Something like mid cap index trading at 35p in itself it's been in no man's land for some time now, trading at a premium of 75% to Nifty. I don't think in the past when this has happened. So clearly the risks are many given the valuations that you are negotiating with in the broader market. Nifty is still very reasonable.
Ashish, I wanted to come, to you on a point that Ajay was making a while back about how retail money has been flowing into this market in a big way, right? I mean, if you just look at the domestic institutional investor data, they've been buying consecutively for the last 11 days. But on the flip side, the FIIs has been a little bit wishy-washy. What's your sense of which way things could head in terms of the money flow into India? Do you think the large chunk of it will still be domestic money?
See, FIs have their own compulsion, right? For them, the world is their playground. It's not just India. Although I feel the interest on India is extremely high, but when they just look at India from a global lens, from a valuation lens, India just seems more expensive. However, there are very, very few markets or none which offer this kind of growth runway. over the next few years, the kind of balance sheet that the country has, able to develop, and the kind of visibility that you have on corporates, right? So my sense is, look, eventually FIs will come in. I mean, they are also driven by rates globally. I mean, right now there is a China trade going on because China relatively seems extremely cheap. So there is a contrarian trade going on. So I feel that FIs will come in at some point in time. However, having said that, the retail flow continues to be extremely strong. And like I said, if you look at just the wealth that is sitting with the top 40,000 ultra HNI households is about $1.5 trillion, right? If you go down one step further, about $360 billion is sitting with about 2 lakh households. And if you go one more step downwards, about $800 billion is sitting there, right? And a lot of this wealth that has got created for promoters is no longer paper wealth. If you look at the number of block deals that are happening, right, and we just did some estimation that what is the potential block deal size over the next few years, and it could be as high as 15-20 lakh crores. And what is happening is, once the block deals happen, a lot of these promoters are creating their own family offices, and part of that allocation is going back to equities through wealth managers like us. So I think the domestic flow continues to be strong. I only dread to think if FIs also turn positive and they start coming into India, it is going to be a very, very crowded trade. So whilst, what Gautam is saying is absolutely right, that valuations look extended in certain parts of the market. However, with this kind of an optimism and flow, I would believe that valuations, even if they get slightly cheaper, the buying interest will come in a very big way. From FIs and domestics continue to be consistent buyers, and I think the SIP is the best part of this entire story because people who are coming into the market regularly, right? SIP has grown at 28% per annum, by the way, over the last 5-6 years, right? And this is capital that is making IRRs on a regular basis, right? So I think the domestic investor story looks extremely strong, and FIs, I believe it's a matter of time, and whenever they're comfortable with valuations or whenever they're comfortable with the relative interest rate trade, they will definitely come in. But at that point in time, it's going to become a very, very crowded trade.
These are staggering numbers, Ashish. 40,000 ultra HNIs are sitting with a wealth of 1.5 trillion, $36 billion with 2 lakh households in India. And I think the potential block deals, this 15 to 20 lakh crore of potential block deals, this is over the next 12 months?
Over the next 3 to 4 years, I mean, potentially how much the promoters need to dilute, because there have been a lot of IPOs that have happened, right? And a lot of these IPOs, you offer 10%, 15%, but eventually you have to go down to 75 to meet the SEBI norm. And a lot of companies, you've seen the market caps go up 4, 5, 6x over the last 2 to 3 years. And a lot of these promoters are thinking of taking some money off the table. And like Gautam said, I think the first thing that a lot of people love to do is buy a large house. So we see traction in the luxury real estate market as well. But after doing that, all of them want to create a family office and look at allocating this money back into financial markets.
Okay, well, Gautam, Ajay and Ashish, thanks a lot for joining us and speaking to us about everything related to the markets as well as the retail sentiment and your conference. Enjoy the rest of your conference. Thank you so much for being with us on the channel. Well, with that, it is a wrap on Trading Hour, but stay tuned. Halftime Report is up next.